Hello everybody, welcome to my channel. This video covers the very basics of accounting and starts with an interesting question that you may have never heard of. You may know what financial statements are. Yes, they tell us valuable information about a company's financial performance and include various types of documents. Then take a guess. Which of the four financial statement documents is the most essential? The income statement, the balance sheet, the statement of cash flows, the statement of stockholders' equity? The answer is the balance sheet. Now we will explore what the balance sheet is and why it is important. The balance sheet is a snapshot of a company's financial position at one point in time. So the balance sheet has a date, usually the end of a financial year. Then, how would you show a static financial position of a company? First, the balance sheet shows what the company owns. It is called assets, which indicate the economic resources the company owns. What kind of assets are there? Usually cash, accounts receivable, inventory, fixed assets, etc. Assets fill the left side of the balance sheet. Then what goes on the right side? The items there represent who the assets belong to. Yes, they are liabilities and shareholders' equity. Liabilities represent what is owed to the company's creditors. Liabilities can include accounts payable, bank loans, etc. Equity reflects the portion that is owed to shareholders. For example, capital contributions from shareholders and retained earnings can be found in the shareholders' equity section. Therefore, you can find out what economic resources a company has at the end of the financial period, and also how much portion of the resources belongs to creditors and shareholders respectively. As an example, let's look at the balance sheet of Microsoft at the end of June 2022. You can see that Microsoft has a surprisingly high amount of liquidity. The total current assets of $169,684 million is almost half of the total assets. On the other hand, long-term debts and liabilities account for the majority of total liabilities. Meanwhile, the total shareholders' equity of $542 million is slightly less than the liabilities, but the debt-to-equity ratio is still in a safe range. Finally, you can see that the amount of total assets is exactly the same as that of total liabilities and shareholders' equity at $364,940 million. Is this just a coincidence, or is it inevitable? Yes, it is perfectly balanced at all times. This is because the balance sheet is deliberately structured to serve this purpose from the beginning. In the balance sheet, equity is defined as the shareholder's residual interest in the assets of a company less its liabilities. It's like saying that the shareholder's legal claim to the assets of a corporation is limited to what's left over after paying off its creditors. For example, if a company's total assets are $100 and its total liabilities are $40, then the amount of shareholders' equity is determined to be $60. Right, it is always true in accounting that assets use liabilities plus shareholders' equity. So the assets on the left side of the balance sheet are perfectly balanced with the liabilities and equity on the right side. The name explains itself. Furthermore, net assets are defined as the total assets of a company minus its liabilities. It means that net assets are always equal to shareholders' equity. This identical equation is the primary rule in accounting, like Newton's law in physics. It should never be overlooked. It's because the balance sheet reflects the essence of the accounting system more clearly than other financial statements. Yes, it is the double-entry accounting system. Under the double-entry system, each financial transaction affects at least two accounts. One account is debited, and another is credited with the same amount. You may have seen an accounting journal entry like this. In simple terms, the debit indicates the left side, and the credit indicates the right side. Thus, the double-entry accounting system is based on the simple principle that the balance, or its change of the left side, should always be equal to that of the right side. Yes, it is exactly the same as the balance sheet structure. Therefore, the balance sheet is a direct reflection of the double-entry accounting system. In contrast, other financial statements, such as the income statement or cash flow statement, do not directly reflect the double-entry nature of the accounting system. Rather, they can be derived from the change in balance sheet items over a period of time. I'll explain these statements in more detail later. Then a question would be how a double entry works and how it changes the balance sheet. My next video will answer this question. See you there soon.